Let's take a moment to talk about something that, while it might sound a bit dry at first, is absolutely crucial to understanding the financial health of any business: the balance sheet. Now, I know what you're thinking: balance sheets. Really? But hang in there with me, because understanding this concept can actually be a game changer for anyone involved in business, whether you're an entrepreneur, a manager, or just someone curious about how companies work. So, what exactly is a balance sheet? At its core, a balance sheet is a snapshot of a company's financial situation at a specific point in time. Imagine it as a financial photograph that captures everything the company owns and owes at that moment. This includes assets, what the company owns, and liabilities, what it owes. The difference between these two is what we call equity, which represents the ownership value in the company. It's like looking at your personal finances and seeing how much you have in your bank account compared to what you owe on your credit cards or loans. Now, one of the most important components of a balance sheet is inventory. You might be wondering, is inventory really an asset? Yes, it absolutely is. Inventory consists of the goods that a company has purchased or manufactured with the intention to sell. Think of it like this: if you run a bakery, your inventory includes all the flour, sugar, and eggs you have on hand, as well as the delicious cookies and cakes ready for sale. All of these items have a monetary value and can be converted into cash when sold. Let's break it down further. On a balance sheet, assets are categorized into current assets and long-term assets. Current assets are items that can be converted into cash within a year. This includes cash in your business checking account, accounts receivable, money owed to you by customers, and, of course, inventory. Inventory is usually listed among the most liquid assets because it can be sold relatively quickly. But not all assets are created equal. Long-term assets, on the other hand, are things that can't be converted into cash within a year. This includes physical items like machinery, buildings, and land, as well as intangible assets like patents or trademarks. So, if we think about our bakery again, the ovens and the shop itself would fall under long-term assets, while the flour and baked goods would be current assets. When we look at a balance sheet, we also need to consider liabilities. Liabilities are what the company owes to others. Much like your personal finances, if you have a mortgage, student loans, or credit card debt, those are your liabilities. In a business context, liabilities can also be divided into current and long-term. Current liabilities are due within a year. Think rent, utilities, payroll, and any short-term loans. Long-term liabilities are debts that will take longer to pay off, like mortgages or long-term loans. Now, why are we diving into all this? Because understanding how to read a balance sheet, especially the inventory section, can provide incredible insights into a company's operations and financial health. For instance, how do you calculate the inventory value for a balance sheet? It's not as complicated as it sounds. The formula is pretty straightforward. Beginning inventory plus purchases, cost of goods sold equals ending inventory. This formula shows how much inventory you have at the end of a period, which is crucial for understanding your cash flow. If you're selling a lot of products, your cost of goods sold will increase, which means your inventory levels will drop. On the flip side, if your sales are slow, your inventory might pile up, which can lead to cash flow issues. And here's where it gets interesting: the way we manage inventory can significantly impact our business. For example, if you're in a manufacturing business, you'll have different types of inventory. You'll have raw materials, like flour and sugar for our bakery, work in progress items, like cookie dough that's not yet baked, and finished goods, which are the cookies ready for sale. Each of these categories plays a role in your overall inventory valuation. But it's not just about what you have, it's also about how quickly you can turn that inventory into cash. This is where the inventory turnover ratio comes into play. It measures how many times your inventory is sold and replaced over a period. A high turnover rate means you're efficiently selling your products, while a low rate might indicate overstocking or issues with your sales strategy. Now, let's take a moment to consider the service industry. You might think that inventory is only relevant for product-based businesses, but that's not entirely true. Even service-based companies have inventory, though it's often intangible. For example, a consulting firm's inventory could include all the research data they've gathered for a project. A hotel might consider vacant rooms as inventory, waiting to be filled by guests. So, how does inventory affect a business? Well, it's a critical asset that directly impacts cash flow and profitability. If you're not managing your inventory effectively, you could find yourself in a tricky situation: too much cash tied up in unsold products or not enough stock to meet customer demand. It's all about balance, much like the balance sheet itself. Let's talk about some risks associated with inventory management. First, there's shrinkage, which refers to losses from theft or errors. If you have a lot of cash tied up in inventory, shrinkage can significantly impact your bottom line. Spoilage is another risk, especially for businesses dealing with perishable goods. If you don't sell your products quickly enough, they can go bad, leading to wasted inventory and lost profits. Then there's obsolescence, where products become outdated or less valuable over time. Think about technology. Last year's smartphone model can quickly lose its appeal when a new version comes out. Businesses need to be mindful of these risks and develop strategies to mitigate them. So, how do you keep track of all this inventory? Many businesses rely on inventory management software, which can help streamline processes and provide real time insights into stock levels. This technology can simplify everything from tracking purchases to calculating turnover ratios, making it easier for businesses to maintain healthy inventory levels. Finally, let's not forget the importance of accurately valuing inventory for your balance sheet. Companies typically use either the cost method or the market method for valuation. The cost method assigns a value based on purchase price, while the market method considers current market prices. Choosing the right method can significantly affect your financial statements and ultimately the decisions you make as a business owner. In summary, inventory is a vital asset on a company's balance sheet, representing goods that can be converted into cash. It's essential to understand how to calculate, manage, and value inventory effectively. By doing so, businesses can ensure they're operating efficiently, maximizing profits, and minimizing risks. So, the next time you hear someone mention a balance sheet, don't tune out. Instead, think about the story it tells about a company's financial health, its operations, and the critical role inventory plays in its success. Understanding this can empower you, whether you're running your own business or simply looking to make informed decisions in your career. After all, knowledge is power, and in the world of business, understanding the numbers can make all the difference.